welcome to the Monday edition of MyStockScanner Live. The start of the week is the perfect time to reset, refocus, and run the markets through the three big questions that we pose them: quality, upside, and timing. The personification of those words are these two gents, Liam Flavell and Hans-Henrik Nielsen. They're ready to answer my questions, but also yours if you send them to us at FOMO@mystockscanner.com. As it is Monday, that means that we will open the 3-point playbook portfolio. This morning, the upside is on, 30.9. And the portfolio had a couple of sells and a single buy last week. I'm not saying the name of the stocks right now, but one of those that you sold, guys, was to the upside tune of 40%, plus 40%. Wasn't it tough to let that go? A bit of saying goodbye to an old girlfriend or something like that?
Nah, we have our rules, so there's never emotions in it.
So simply emotionless when it comes to saying goodbye to a stock like that. We'll bring up the name. We'll bring up the name of the stock later on the show. Today we will also be talking defense stocks. It will be Rheinmetall, and we're going to talk Thyssen Krupp that debuted a new stock on the German DAX exchange. We will be talking Tesla, Zealand, Novo, and Uber. And it is earnings calls week for, I'm almost going to say, the second time in a row. And we will, of course, be looking into the local banks. Because we're having an eye on them because of what they did last week. Scion today comes with numbers. And we also have a couple of stocks that we talked about on Friday, Netflix and Amazon. And Liam, not to go back in time, but just a little bit of those two, we had them in the face-off on Friday. And which one came out the favorite?
Amazon just about edged it, simply because we think it's a better trade from an AI perspective, and there's probably more gas in the tank for them. Netflix was a perfectly good company, almost preferable, because if and when the AI bubble does burst, then Netflix will probably still be up there and powering on. And also, they're not the ones with the outage at the moment.
Exactly, either, so, I was going to mention. AWS have a little bit of an outage, and if there is, if the internet is coughing, it's not your internet, it's the entire internet coughing at the moment. There's a little bit of outages on the East Coast in the US, Liam.
Yeah, so they operate in different what's called availability zones. Their US East 1 is down, which covers probably about 8% of the internet, something like that, I would guess off the top of my head. We use Amazon. This is my smug face now saying we're not affected. We're absolutely fine.
I thought that Hans-Henrik went out the picture to get the sign that said nerd alert, because this was getting a little bit nerdy. I'm sorry about that. But you guys, we spent 3.5 minutes here, and the number of the day is done in minutes and seconds. It's 7 minutes and 30 seconds. What it comes out to, I'll tell you later. But let's get into it, because as said, earnings season is upon us, and Hans-Henrik, he smiles like it's Christmas Eve, because we're going to bring up one of his absolutely favorites, or fave to hate, or whatever it is. We're going to talk Tesla. Coming earnings on Wednesday. Hans-Henrik, Tesla.
God.
Here we go. Get ready.
It's actually not. As I always say, I will gladly give credit to Tesla for the revolution they have made in EVs. Absolutely. The only thing we have basically is it's priced too expensively. And looking at the numbers that comes up, we are expecting that they will show good sales numbers. Everyone expects that. And that is because there was this tax credit in US where you could get a discount, a rebate when buying an EV, not just Tesla, but an EV. And that disappeared. That was one of Trump's promises or threats or whatever. And that disappeared. That means Tesla in Q3 were out saying, hurry up, buy some Teslas, because you get they will go up $7,500 in price. That, of course, got a lot of people to rush into buying Teslas, and that will definitely be shown in the numbers. As we see here, they are actually, the revenue is itching up. Free cash flow is dropping quite a lot, and that is really a worrying part for Tesla, because they have a lot of competitors and they need to put a ton of money into developing new stuff. And if they are lacking cash flow to that, they are either not developing or they have to borrow money. If you look at the valuation, first-time users here might think, oh, this is fantastic. There's a great upside in Tesla. But that is at a PE of almost 260, meaning you're paying $260 for every $1 of profit. So we would say that should definitely go down. How much? We have no idea. These numbers are still high, 100 to 150. But if they go down to that, you can see it's a big black hole.
Can I stop you right here, Hans-Henrik? Because you always, I'm going to say, torture the numbers a little bit. You don't just go with what shows up automatically. And you can do two ways as you did it, go straight into the number part and then write in new numbers so you can pull.
Yeah, I can simply drag here. Yeah. The reason why I put numbers into here is we know that the competitors from Tesla, BYD, for instance, they have a PE that is extremely much lower. And that means if I put that number in, it would look completely ludicrous because it would say minus 90% in potential for Tesla. But it's just to say we think it's completely insanely wrong price right now. That doesn't mean it can't go up. It just means that if it goes up, people are taking a larger risk when buying. They're paying a higher PE. And also, I know, Liam, there's a bit of misunderstanding. Some people are thinking, let's buy Tesla because what? Some tech?
It's not even misunderstood. It's not even some people, actually. It's I'm not going to say which podcast it was, but there was a podcast from one of the top major news suppliers out there.
Rhyming with Stuhlberg, wasn't it?
Something like that. And the technical correspondent actually said that Tesla have shares in and own part of XAI, which is the AI side of Elon Musk's empire. And you might have heard of the Grok, the Grok LLM, the chatbot that you can talk to. And it's not true. Tesla do not have any ownership whatsoever into there. So a lot of people misconstrue the fact that Tesla have got this big, wide, expanding empire of spaceships and things like that. That's not. Elon Musk has got it. Yep. Tesla do cars.
Yeah, exactly. Because I was gonna ask: is it a car company? Is it a tech company? And I think that a lot of people see it as a tech company.
Yes, and the future side of things, the batteries and those sort of areas are future growth, but they're a very small part of the current earnings mix. So the earnings mix is based cars.
I saw an analysis, just to mention that quick, just of a month ago, saying that Tesla is the company in S&P 500 where most of the valuation is based on expectations, visions for the future. They're talking 95 to 97% of the pricing is basically priced on hopes, on robots, on would almost say flying cars, but at least self-driving cars. And that is a risk to take. Doesn't mean it can't pay off, just meaning we're not buying it.
And we will get into details with more stocks during the way and tell how the 3-point playbook is affecting what we are investing in. But if we zoom out just a little bit and look at the macroeconomics of things, then the shutdown is still going. Nobody's just talking about it anymore. Trade war, well, it will make the headlines. And talking headlines, then one of the headlines I saw this morning was that China says their economic goal is within reach, despite a weakest growth in a year. Hans-Henrik, what's up with China in that sense? I heard 5.2 versus 4.8 in growth.
Yeah, let's not nerd too much in the numbers. Basically, they came out with a lot of numbers. They are one of the two superpowers in the world right now that actually produces numbers we can use for anything. Since US is shut down, we cannot really count on them. But overall, even though it's not perfect, there is some house pricing that was a bit better, bit lower unemployment, somewhat better retail sales, and so on. What that tells us as investors, because we can nerd economic numbers from now till forever, but what it tells us is that China is in an okay shape. We saw that they are actually still exporting quite a lot, even though not to US. That means that the world is actually trading. There's movement of goods in the world, and that's a good thing for us as investors.
If we go into something a little more closer to our borders, in Europe, well, it was mainly all of defense stocks all over the world took a hit on Friday. There was a drop. One of our users wrote us at FOMO at MyStockScanner.com and asked, "Is this a buy the dip situation?" It's one of the favorite questions that you guys have out there. It's an opportunity to buy, and I love that you're so eager investors. But was it a situation? I can see when I look at my screen, the same stocks are up today. So there was a buy the dip.
Yeah, it was a tiny dip. 3-4% in the realms of things. It sounds like a lot, but Rheinmetall was our biggest winner this year. That was up 170-180% by the time we sold it. Saab was up. So we've had a phenomenal run in them, and so that's why everyone's looking at them again, saying, can it repeat itself? Because these are still very high quality companies. They're just quite expensive at the moment.
We bought a couple that we thought was fair price. They are up today 3% and 1.5% today. So it seems like defense is up again.
Yeah, it seems like we're not having world peace anymore, like everyone assumed over Friday. And we might still need some rockets and bullets to throw at people. But if you look at Rheinmetall, which is what the question was about before, you can see from the playbook page here, the earnings per share is going through going like a rocket, let's call it. You can also see the PEG ratio is actually pretty good. So it's a very high quality company at 90. So I often say to people, I can tell within about 3 seconds just by looking at the quality score over here and the PEG ratio of 1, which shows us how much that growth is priced in already into the future price. That below 2 and a high quality score says to me that's a really interesting company that I want to look at. And you can see the rest of the playbook sort of page is quite green. Where we come unstuck slightly at the moment is we're right up here on the green on the bull side of things. If we're just looking for the next 3 to 6 months, there may not be too much upside in the stock. So here, if we held it for 3 months, there's a 14%, 30% downside according to the analysts and us, and there's only about a 12% upside in the best of cases. If we're looking to hold to next year and we're starting to look at next year's numbers, that changes the picture dynamically.
Just to mention quickly, the difference that we have to remember, even though they're defense stocks, they are industrial stocks, meaning they need manufacturing capacity. And right now, the pricing, the development that is priced in is that all the future shooting in Europe is basically priced in. They cannot produce any faster than they do. So the next year or two, they will struggle to get some more manufacturing capacity up there. So for their sake, let's hope the war goes on.
Yeah, it's a weird wish to have.
It's really weird.
Yeah, it goes against a lot of things. But if we say I won't say smaller brother or bigger brother, whatever it is, but we stay in Germany, and I'm trying to segue over to Thyssen Krupp here today, that debuted a new stock on the stock exchange today in Germany. TKA, that's Thyssen Krupp, but TKMS is sort of the marine side of things. And the way that they did it was for every 20 stocks you had in Thyssen Krupp, you got 1 stock in the TKMS. It kind of bounced around for a little bit and is trying to sort of, stay in the water somehow and find its value. You guys would never ever buy a stock like that on a day like this.
Well, first of all, Thyssen Krupp, quality score of 9, earnings per share that is just, estimated to be positive, but it has been all over the place. Looking at the value graph here, it's basically impossible to get anything out of. So we would not buy Thyssen Krupp in itself. What happened this morning was that Thyssen Krupp dropped quite dramatically. They are having this the warship thing is being taken out of the company and listed in itself. And Thyssen Krupp fell, 20%, something like that this morning?
19 right now.
19%. And I didn't really get it. The math didn't math here. It didn't add up with what you got. You got that one marine warship thing for was it every 20 Thyssen Krupp?
But they were giving away marine ships for every share, 20 shares that you had. I would have gone into
there was
that. I could do with a warship.
There's something for the swimming pools for the summer.
Yeah.
The thing is that it seems, I read some analysts saying that Thyssen Krupp was a terrible company, basically boring, non-growing, and all that kept it up basically was a marine ships, a warship thing. And looking at the warships, the TKMS, the ticker this morning, it started down here at 60 and now it's up, 50%, something like that. And that is just showing that this is what people think is interesting. That is the war thing of it.
We'll have to see. It's never a stock that you would go into an IPO. It's simply against your rules for your portfolio. And talking about the portfolio, we're going to jump into it now. 3-point playbook portfolio up 30.9% on the year. And last week you sold a couple of stocks and you bought a single stock. Quickly, we are going to jump to the one that we talked about, the girlfriend that you let go, so to say. I'm not offending your wives, I hope. But anyway, the Uber stock was let go.
Our girlfriend.
It's leaving by an Uber. Yeah.
You sent her off in an Uber. Why did you do that?
There's no doubt Uber is a fantastic company, and I think they have a huge potential in the future. We were just in this morning talking about robotaxis and all that. They're not producing the robotaxis, they're just buying them when they eventually work, so that is okay. Earnings per share have been a bit all over the place, but is looking at some reasonable growth. We can see cash flow is coming along and so on. What we did was, first of all, we were up 40-something%, and the price have gone up quite a lot. As you can see, the earnings dropped a bit this year, set to grow a bit next year, and we were in a fairly expensive zone. And looking at what started to happen was, I know it's not severe, but we had a double red down here in our MTI indicator. That indicates that both on a daily and a weekly, we're starting to see some weakness. Then it broke down through the 50-day moving average, broke down through a trend line, and so on. Market was very nervous, so we said, let's take the 41%.
And you did, and you're not unhappy about it.
Oh no, we can always buy into it again if it.
That's the thing. I was going to say you don't have a sort of a politic that says, well, we're never going to get back into it. You can buy back into it.
We are not religious in that in any way. We can buy into a stock 5 times, and every time we get sold out, buy it again.
Yeah, and.
Yeah, and what we have seen as well in the portfolio, just as a general rule, is we almost get a bit of an indication when there's market turbulence coming, because we start seeing these sell on good quality, high quality stocks. We were, I think at the beginning of the month, we were about 80% invested. Now 2.5 weeks in, we're down to around 50%.
55.2%.
Yeah.
And that doesn't mean that we think the market is going to crash. It's just that when we get a lot of volatility, we tend to get stopped out, which means that often when the market is turning over and then eventually dropping, it always comes with a lot of volatility. Not always dropping, but that means we are being sent out before the crash. In April, we had the maximum drawdown at 7%. Back in 2020, at the COVID situation where the market dropped 35%, I was down 11%. And that is simply due to this strategy. It doesn't mean we beat the market every year, but we always have low volatility and low drawdowns.
Yeah, and just one thing I'd add just to the end of that, the bottom of the market for us was the 21st of April. We started buying stocks, TSM, Oracle, companies like that on the 21st to the 25th. So we actually did get in pretty much at the bottom of that downswing, which we often say we don't, but that was
it's just that we can't guess where the bottom is. Eventually, sometimes we get lucky, but...
Yeah. And one thing is that you go for, of course, a profit, and you want to set a percentage and stuff like that. But it's equally important, sort of, getting your strategy right on when you leave the market. That's one of the things that
we are only right 52% of the time so far this year. Normally that is 60 to 65%, but in this volatile environment, we are being sent out a bit more. So we are right 52%, and some people would say that's terrible, but it's not when your average winner is 27%. So if we take 100 trade, the 52 of them will make 27% on average, of course, and the 48 of them will make minus 6.5%. That is a mathematical sure way to get a good investment business.
And I know one of the stocks that you have been, should we say, taking a dance or two with, not always for profit, was Novo. You went in and out, and on Friday they were down 6.4%. But and you called Zealand sometimes. Do you call it Novo on steroids, or what you say?
Yeah.
Because on Friday they were down 8.4%. They're coming back a little bit today, up 2%. What's going on with Zealand?
Well, Zealand, the entire Wegovy Ozempic ride that was back here the last couple of years, Zealand Pharma was riding on that. Even though they didn't have a product ready, there were rumors about one. They were testing something out that apparently is better than Novo's. Let's see where that ends. Then Novo kind of crashed, and Zealand Pharma crashed even harder. And it is like Zealand Pharma is a bit of the younger brother, leaning a bit on Novo. So when Novo drops, they drop more. And so let's see where that goes. If we should go into Zealand Pharma, just from a technical point of view, nothing fundamental here, we would need to see a break of this 200-day moving average coming up here, a break of that, a retracement to it, and then showing some strength. That we would also need the fundamentals to be right, of course.
And to be fair, Novo was approved by the FDA by their diabetes pill to reduce heart risk. It's called Rybelsus. If I say that right, I hope so. So that's another reason that they are seeing a bump today of 3.6%. But it's one of those stocks that, as I said, you have taken a couple of dances with them and not always for profit.
Oh no, and I went in and out of it several times back here in 22 and 23, where it went down enough for me to be sold out of it, and then I went into it again. But again, we are not looking to necessarily have a stock that goes up 200%, 300%, 500%. We did with Rheinmetall and Saab, that was great. But we would rather have lower risk and then be in the smaller runs that we would necessarily try to squeeze the last couple of percentages out of a trend. Some people can do it. It's just not our strategy.
And it is awfully hard to predict the market. What we can predict is what we're having on the show for the coming days. Of course, on Wednesday, we have the Wednesday watch list, which is the result of our Tuesday poll that we'll put up tomorrow in all our SoMe areas on Facebook. So you can vote on that. That will come to the Wednesday watch list. And on Friday, of course, we have the face off again. And remember, it's still available. You can go in and read the article on our website, on our platforms. It was Amazon versus Netflix, both of them coming with earnings today. And talking about those two, the number of the day was 7 minutes and 30 seconds. That is exactly how long time it takes Amazon to make $1 million. 7 minutes and 30 seconds. And you think, wow, that's fast. But no, like Microsoft do it in 5 minutes. Google do it in 4 minutes and 54 seconds. Apple a little slower, 5 minutes and 12 seconds. And if we look sort of down at the really slow ones, the turtle ones, that would be Meta. They spend 7 minutes and 48 seconds. We spend a little longer. You're
not really motivated to take a half an hour lunch break, then, are you?
No, you're not. If that takes you to 1 million. So, but tomorrow on Netflix, GE Aerospace, Coca-Cola, Philip Morris, L'Oreal, amongst those who bring out earnings. We already said it. Wednesday will be Tesla, IBM also, and then Thursday Amazon. So there's a lot of things to look forward to. You guys, is there anything that you sort of look forward to this week? Are there any sort of key moments in numbers, in earnings that you're looking out for?
Well, my answer is obviously the Tesla part. Netflix is also interesting, but I think we start to get some of the interesting things. But next week and the week after, they're the big ones coming out.
Yeah, for me, Amazon, they're the largest cloud provider in the world. So what they're doing and what they're investing in, that leads the market. And then
it hasn't been for the last 20 minutes, have they?
always the sunshine, isn't he? That's it. Liam, on Thursday, of course, you will bring forward the article that's called Thursday Tech, where Liam sort of takes the magnifying glass on the tech industry, but also kind of look into the future and see what's awaiting us. And remember, the articles and in-depths are on our pages. They are on Facebook. And also ask questions in there. But first and foremost, ask questions on FOMO at MyStockScanner. .com, because that's where we really want to take your questions, and that way we can bring them out to everybody. And that's how we start the week on MyStockScanner Live. We try to keep it simple. We definitely want to aim for keeping it smart. It's quality, it's upside, and it's timing that should guide every decision. Well, I'll see you guys on Wednesday. Have a good one. Happy investing.
You too.